The silver market didn't weaken slowly, it snapped, and almost no one is ready for what China and Russia have just set in motion. That single fact alone should force you to pause, because markets don't snap unless a pressure point has been ignored for far too long. What you're about to read is rarely explained honestly, not because it's complicated, but because it threatens the deepest assumptions of the global financial system. Assumptions most people never even realize they are living under. For decades, silver was treated as abundant, secondary, almost irrelevant. It was labeled a poor man's gold, an industrial sidekick, a metal that could be pushed around, shorted, leveraged, and diluted through paper markets without consequences. Price suppression became normal. Volatility was engineered. Physical shortages were dismissed as temporary noise. The belief was simple and comforting. Silver would always be there, always cheap, always controllable. That belief is now collapsing in real time. To understand why this matters, you have to understand how modern markets actually function. Most people assume prices reflect reality: supply, demand, and scarcity. In truth, prices reflect confidence in systems. Silver's price has long reflected confidence in paper promises. Futures contracts, ETFs, unallocated accounts, and derivatives that represent ounces that may never exist in physical form. As long as trust remains intact, this illusion can persist indefinitely. But when trust erodes, the math stops working. China and Russia understood this long before the snap occurred. They didn't announce it. They didn't warn anyone. They simply acted. While Western capital markets obsessed over liquidity, yield, and leverage, these nations focused on something far more primitive and far more powerful: control over real assets in a world drifting toward fragmentation. Silver, unlike gold, plays a dual role. It is both monetary and industrial, financial and physical, strategic and consumable. That makes it uniquely dangerous to misprice. Silver is not hoarded and forgotten. It is burned into solar panels, embedded in electronics, fused into military hardware, medical devices, and energy infrastructure. Every year, millions of ounces disappear permanently. Recycling recovers only a fraction. New discoveries are rarer, mining grades are falling, and production growth is stagnating. Yet, on paper, silver supply appears limitless. That contradiction is not sustainable. What makes this moment different from every previous silver scare is the geopolitical backdrop. The world is no longer unified under a single monetary and trade framework. Sanctions, trade wars, currency weaponization, and fractured supply chains have forced nations to think in terms of resilience rather than efficiency. China and Russia are not preparing for the next quarter. They are positioning for the next era. In that era, access to physical resources matters more than financial engineering. The snap didn't happen because of one event. It happened because a long-running imbalance finally crossed a threshold. Physical demand quietly overtook available supply, while price signals remained frozen in a paper-based past. When enough real buyers stop accepting promises and start demanding delivery, the market doesn't adjust politely. It breaks. And, once broken, it doesn't heal on a schedule that benefits late observers. The most dangerous part of this collapse is how invisible it still feels. There are no flashing alerts on mainstream financial media. No emergency meetings broadcast live. Just subtle stress fractures, delayed deliveries, shrinking inventories, rising premiums, and strategic stockpiling that never makes headlines. This is how paradigm shifts always begin: quietly, uneasily, while the majority remains distracted by surface-level narratives. The belief that silver is abundant, secondary, and suppressible was never a law of nature. It was a convenience. And, like all conveniences built on fragile assumptions, it holds only until reality asserts itself. That assertion has begun, not with noise, but with irreversible motion that cannot be undone by policy statements, interest rate adjustments, or reassuring commentary. Here's the hidden truth. Silver is no longer just an industrial metal. It has become a strategic asset, and that shift changes everything. The moment a resource moves from being useful to being essential, it stops behaving like a normal commodity. It becomes a lever of power. And power, unlike price charts, is never accidental. There are effectively two silver markets operating at the same time, and they barely acknowledge each other. One is loud, liquid, and digital, futures contracts rolling endlessly, ETFs expanding and shrinking with capital flows, headlines reacting to inflation prints, and interest rate rumors. This is the silver most investors see. The other market is quiet, physical, and strategic. This is the silver China and Russia care about. And the gap between these two markets is now the most dangerous fault line in global commodities. Western markets treat silver as a financial instrument. Ounces are abstracted into tickers, leverage is piled on top of leverage, and delivery is something that almost never happens. Price discovery lives in a world of margins, collateral, and settlement dates. In contrast, China and Russia treat silver the way civilizations have always treated critical resources, as something you secure, store, and integrate into long-term national planning. China's role is impossible to overstate. It is not just the world's factory, it is the world's energy transition engine. Solar panels, electric vehicles, grid-scale batteries, semiconductors, 5G infrastructure, medical technology, all of them rely on silver's unmatched conductivity and reliability. There is no substitute that performs at the same level without significant trade-offs. Every efficiency gain in green technology increases silver intensity, not reduces it. As China accelerates production, silver consumption doesn't rise linearly. It compounds. What makes this even more critical is that China doesn't approach supply chains as markets. It approaches them as systems. Long-term contracts, overseas mining investments, strategic stockpiles, and quiet accumulation define its playbook. When silver is acquired, it is rarely resold back into the market. It disappears into manufacturing pipelines, state reserves, and infrastructure that will function for decades. From a market perspective, that silver is effectively gone. Russia's position is different, but equally disruptive. Cut off from Western financial channels, Russia has been forced into a reality most nations are only beginning to imagine. A world where access to dollars, clearing systems, and Western capital is no longer guaranteed. In that world, trust in paper claims is a liability. Real assets become currency. Trade begins to revolve around what can be delivered, not what can be promised. Silver fits perfectly into this framework. It is compact, universally recognized, divisible, and critically useful. It can facilitate trade, support industrial output, and anchor value outside traditional banking systems. As Russia restructures its trade relationships across Asia, the Middle East, and the Global South, resources like silver move from being commodities to being instruments of settlement and leverage. The result is a steady, relentless drain on the physical market. Not dramatic, not explosive, just persistent. Every month, more silver is locked into long-term use, while the paper market continues to behave as if supply were endless. This is the most deceptive phase of any market shift, because nothing appears broken yet. Prices still move within familiar ranges. Liquidity still exists. Confidence remains mostly intact. But beneath the surface, inventories thin, delivery times stretch, and premiums rise in ways that don't quite make sense if you only look at spot prices. These are not anomalies. They are signals. Signals that the physical market is tightening while the financial market remains anchored to outdated assumptions. Strategic assets don't announce themselves. They reveal their importance only when access becomes restricted. And by the time the world collectively agrees that silver is no longer just metal, it will already be positioned where it needs to be: inside factories, inside vaults, inside systems designed for a future that no longer prioritizes financial convenience over physical reality. The economic mechanism behind what's happening to silver is not complex, but it is unforgiving. Paper supply can expand infinitely. Physical silver cannot. That single asymmetry is enough to destabilize an entire market once reality intrudes. As long as participants accept paper promises as equivalent to metal in hand, the system functions. The moment that assumption is questioned, the imbalance becomes impossible to contain. Silver is unique among major metals because it is both critical and consumable. Gold sits in vaults and jewelry boxes, largely untouched by time. Silver does not enjoy that luxury. It is soldered, fused, vaporized, and dispersed across millions of products. Smartphones, solar panels, medical instruments, military systems, all consume silver in forms that are uneconomic or impossible to recycle. Once used, a significant portion of silver is gone forever. This creates a one-way flow that paper markets simply ignore. Above-ground inventories are the real constraint, not annual mine production. Mines can take a decade to develop. Grades are declining. Energy, labor, and regulatory costs are rising. Even if prices were to surge tomorrow, supply would not respond quickly enough to prevent stress. Meanwhile, demand does not pause for price signals. Governments don't delay energy transition. Militaries don't suspend procurement. Manufacturers don't halt production because a futures curve looks stretched. Real demand is stubborn, and it is accelerating. Paper markets, however, operate on entirely different logic. They assume liquidity can always be created. If demand increases, more contracts are issued. If prices rise, leverage expands. This works until a critical mass of buyers stops caring about exposure and starts caring about delivery. At that point, the market's function shifts from price discovery to survival. History has already shown how this plays out. Uranium spent years trading at prices that made no sense relative to production costs. Utilities relied on secondary supply and paper arrangements, assuming availability was guaranteed. Then, inventories tightened, contracts were called, and the market didn't climb. It leapt. Nickel followed a similar script, where paper positioning overwhelmed physical reality until delivery risk forced an instant repricing that stunned even experienced traders. Energy markets offered the same lesson when long-ignored constraints suddenly mattered. These were not gradual transitions. They were violent corrections. Markets didn't have time to adapt psychologically. Prices reset to levels that forced reality back into alignment. Silver now carries the same structural characteristics, but with an added layer of complexity. It is embedded in the monetary system itself. Unlike uranium or nickel, silver intersects with currency confidence, inflation expectations, and geopolitical trust. When real demand collides with limited above-ground inventories, the outcome is not a smooth upward trend. It is a discontinuity. Price charts do not slope, they gap. Liquidity evaporates. Sellers vanish. Buyers become aggressive, not because they want upside, but because they fear not getting access at all. This is when price stops being about value and starts being about availability. What makes silver's situation especially unstable is the scale of paper claims relative to physical supply. The market has grown accustomed to a world where exposure is easy and delivery is optional. That comfort dissolves rapidly when physical constraints assert themselves. A market built on rollover and netting cannot withstand sustained demand for settlement. This is not a theory or a forecast. It is a mechanical outcome. Infinite claims, meeting finite reality, can only resolve one way. Silver is now entering the phase where that resolution begins to matter, not just for traders or miners, but for currencies, industries, and nations that have built strategies on the assumption that paper and physical are interchangeable. Here's the wow moment most investors never see coming. Silver isn't merely undervalued, it is structurally mispriced by a system that confuses confidence with reality. For decades, price has been determined not by scarcity, utility, or strategic importance, but by faith in paper claims layered on top of each other. Futures, options, swaps, unallocated accounts, all of them assume the same thing: that silver does not need to be present to be priced. As long as that assumption holds, the market appears orderly. When it fails, the entire framework dissolves. To understand why silver transforms so violently, you have to step outside modern finance and look backward. For thousands of years, silver was money. Not symbolic money, not credit-based money, physical money. It circulated because it required no counterparty, no trust in an issuer, no clearing system. That role never disappeared. It was merely buried under layers of financial abstraction. Today's pricing system treats silver as if that history no longer matters, but history doesn't vanish. It waits. A commodity becomes money when trust in intermediaries weakens. This isn't ideology, it's pattern recognition. When systems fragment, when currencies are questioned, when settlement risk rises, assets that carry no promise attached to them reassert themselves. Silver has every property required for that transition: divisibility, recognizability, portability, and intrinsic utility. Unlike purely financial assets, it doesn't rely on solvency or policy credibility. It simply exists. The mispricing is structural because the system was never designed to handle silver being demanded as money again. Paper markets assume velocity without withdrawal. They assume holders want exposure, not possession. The moment enough participants seek physical settlement, not for speculation, but for assurance, the pricing mechanism breaks. This is when silver stops reacting to macro data and starts reacting to fear of exclusion. When that shift occurs, silver no longer trades like copper or aluminum. It doesn't respond politely to interest rates or growth forecasts. It responds to trust. And trust is binary. It doesn't erode smoothly. It collapses. 1 week delivery is optional. The next, it's impossible. 1 month inventories seem sufficient. The next, they are functionally gone. This is why silver's historical moves are so extreme. They are not rallies. They are resets. Detonation is the right word because expectations are what explode first. Analysts anchored to traditional valuation models are blindsided. Investors waiting for confirmation discover that confirmation only arrives after price has already moved beyond reach. Liquidity that once seemed abundant vanishes as sellers refuse to part with physical metal at any price resembling the past. The market doesn't ask for permission to reprice, it enforces it. What makes this moment especially destabilizing is that silver's monetary reawakening would occur in a world already strained by debt, inflation, and geopolitical mistrust. In such an environment, the reappearance of a non-sovereign monetary asset is not a curiosity, it's a signal. A signal that the architecture of value itself is being questioned. Silver's behavior in that phase cannot be extrapolated from spreadsheets or historical averages. It behaves according to psychology, availability, and urgency. And once silver crosses the line from being treated as just metal to being recognized as monetary insurance, the market no longer debates price. It debates access. As debt explodes, inflation refuses to fully retreat, and the global order fractures into competing monetary spheres. The rules that governed wealth for the last 40 years begin to fail quietly, then all at once. This is not a temporary cycle or a policy mistake that can be corrected with a rate cut or a liquidity injection. It is a structural transition away from a unipolar financial system towards something more fragmented, more regional, and far less forgiving. In that environment, assets tied to real, inescapable scarcity stop being optional. They become dominant. For decades, growth was driven by leverage, financialization, and the expansion of claims on future productivity. Debt became the primary tool of economic management. Today, that tool is exhausted. Sovereign balance sheets are bloated. Central banks are trapped between inflation and instability. Every new unit of debt delivers less growth and more fragility. In this landscape, trust in long-duration promises erodes, not dramatically, but persistently. Capital begins to migrate toward things that cannot be diluted, restructured, or printed. Silver occupies a rare and uncomfortable position in this shift. It is not purely defensive, like gold, nor purely cyclical, like base metals. It sits at the crossroads of the modern world's most critical systems. Energy infrastructure depends on it for efficiency and reliability. Advanced technology relies on it for conductivity and precision. Defense systems require it for performance and durability. And, at the same time, it carries a monetary legacy that resurfaces whenever confidence in institutions weakens. Few assets are pulled simultaneously by so many non-negotiable forces. This convergence matters because it compresses time. Demand for silver is no longer driven by a single narrative that can fade or reverse. Energy transitions don't pause. Technological complexity doesn't simplify. Geopolitical competition doesn't de-escalate on a schedule. Each of these forces reinforces the others, creating a demand structure that is rigid, not elastic. When supply cannot respond, price becomes the only variable left to adjust. The shift toward a multipolar monetary order accelerates this dynamic. As trade increasingly settles outside traditional reserve currency frameworks, credibility replaces convenience. Nations and institutions begin to value assets that function across borders without permission. Silver, compact and universally recognized, fits that requirement in a way few modern financial instruments can. Its value does not depend on alignment with any single power center, which is precisely why it becomes more relevant as power disperses. The real question then is no longer whether silver will reprice. That debate belongs to an earlier phase, when outcomes still felt theoretical. The question now is who understands the nature of the transition early enough to position themselves before price becomes the messenger. Markets do not reward awareness at the moment of consensus. They reward those who recognize structural shifts while they are still uncomfortable and easy to dismiss. Wealth, in this context, stops being about nominal returns and starts being about resilience, access, and optionality. It becomes a measure of how well one's assets align with the direction of the world rather than the narratives of the past. Silver forces that reevaluation because it cannot be fully explained by old models without revealing their limitations.